So good morning. Immediately following a 1-hour presentation, the audience remembers only 2 major points. And the next day, they only remember 1. So I'm going to make it very easy for you to remember all the key takeaways from this morning's presentation. Of course, I'll have all the underlying details over the next hour. All you have to do is remember the word. So the word is delivering. For workers' compensation, direct written premium was flat, while net written premium rose sharply. Employment and wage growth led to an increase in payroll, but that was completely offset by loss cost decreases. There was a very low and historic combined ratio, but investment gains slipped a bit. The gain from operations was significant, and reserve deficiencies completely evaporated. And finally, it appears that economic factors contributed to a milder decrease in frequency, while indemnity and medical severity changes remained moderate. So it's the simplest mnemonic ever conceived, right? Okay, so we like to tee things up each year with the P&C results, and because that helps you put the workers' compensation results into perspective. So that's where we're going to start. Starting at the bottom, property and casualty net written premium for private carriers increased to $611.6 billion in 2018. That's a 10.6% increase, and notably more than what we saw last year. In fact, it's the largest we've seen since 2002, when premium grew suddenly and significantly as a result of 9/11. A number of US-based insurers terminated their offshore quota share agreements, some because of the base erosion and anti-abuse tax called the BEAT provision that came out of the Tax Cuts and Jobs Act. And that increased net written premium without impacting direct written premium. The growth was fairly consistent across lines of business, with the exception of other liability, where net written premium grew about 25%, again, because of the Tax Cuts and Jobs Act. Now, if you recall from last year, workers' compensation was the only line of business where net written premium decreased. Well, this year, we're no longer the outlier. For comp, premium increased by 8.5%, to $43.2 billion. And I'll have a lot more to say about that in the next section, which is all about work comp premium. So here we have the underwriting results by line. In 2018, the P&C combined ratio decreased by 5 points to 99. That's a $23 billion underwriting improvement. All major lines of business improved with the exception of other liability, but their combined ratios have tended to be relatively more volatile in recent years. The big news is that workers' compensation improved by 6 points, and we ended the year with a combined ratio of 83. So I've been in this role for 6 years now, and I've run out of superlatives to describe the workers' compensation results, but I hope to shed some light on what's causing this over the next hour. The one line of business that really improved was fire and allied. It decreased by 16 points. The driver there was lower cat losses in 2018 relative to 2017, and you can see that here. Natural catastrophes are random. We have some really good years, and then we have some really bad years. The average across the US since 2012 has been about $37 billion. And we've highlighted the years that are above average in blue. The spikes are generally driven by hurricanes. So in 2012, we had Hurricane Sandy. And in 2017, we had Harvey and Irma. In 2018, Hurricanes Michael and Florence, together with the destructive wildfires that occurred out in California, drove the total to about $52 billion, which is well above average. The states that were most impacted by hurricanes were across the Southeast. So we've got those highlighted in blue. According to Willis Re, major hurricanes contributed about $15 billion to insured losses in 2018. Out west, in orange, the Camp and the Woolsey wildfires burned over 900,000 acres, and that added about $15 billion to the total. And then the states in green were impacted by either tornadoes or hail or wind or flood, and that contributed another $6 billion. So all in, AM Best estimated that net of reinsurance, cat losses added about 6 points to the combined ratio in 2018. And that's 4 points less than last year and a significant contributor to the 5-point improvement in the combined ratio. Now, there's so many complex variables that interact to move the combined ratio up or down from one year to the next. So I don't mean to suggest that the decrease to 99 was all because of natural catastrophes, but they do play a role. So we have the long-term history of the P&C combined ratio here, and it's had its ups and downs around the break-even combined ratio of 100, with private carriers posting an underwriting profit in only 7 of the 21 years that you see here. But the average over the period is about 102, so it's a pretty good result. In recent years, underwriting discipline appears to have contributed to the good results in what seems to be a perpetually low interest rate environment with low investment returns. NCCI's definition of the investment gain ratio includes realized capital gains and net investment income divided by net earned premium. So in total, the preliminary investment gain ratio dropped by about 1.5 points to 11% in 2018. Since the end of the Great Recession, these have remained in a pretty tight range, somewhere between 10 and 13%. The blue portion of the bar represents the net investment income ratio, and it was flat at about 9% in 2018. The smaller portion of the bar, which is in orange, is the net realized capital gain ratio. And this year, it reverted back to sort of a normal post-recession level. In 2017, realized capital gains were unusually high from the sale of common stock. But in 2018, the industry booked a realized capital loss on its bond portfolio. Now, on average, the investment gain ratios have decreased since the end of the Great Recession. To see some improvement here, we really need for yields to rise. This graph gives you an idea of how the P&C portfolio yields have changed over time. The white line is the historical embedded yield, and it represents the yield on the industry's bond portfolio at each point in time. The orange line is the weighted average new money yield on the bond portfolio, and that's a proxy for the current reinvestment yield. It's as if the industry sort of hit the reset button each year and reinvested its bond portfolio. And then the gray bars that you see there are periods of recession. The orange new money yield kind of bounces around a bit with sharp decreases coinciding with periods of recession. Throughout the period, though, the new money yield has been below the embedded yield, but in recent years, the two have started to converge. Now, the 2018 embedded yield won't be available until later in the year, but it's likely that the increase in the new money yield drove it higher. So one of the best statutory measures of industry success is the after-tax return on surplus, and it improved in 2018 to 8% and above the long-term average. Most years sort of move with the underwriting cycle and do generate some level of return, with the obvious exceptions of 2001 and 2008. The biggest contributor to this year's uptick was the $23 billion underwriting improvement that I mentioned earlier. The other major contributor was the denominator of the ratio, and that's surplus. P&C surplus fell to $744 billion. That's the blue dotted line up at the top. Unrealized capital losses from common stocks and an increase in dividends to shareholders pulled surplus down about $7 billion from its record level in 2017. And when you pair that with significant increases in net written premium that we talked about earlier, the premium to surplus ratio jumped to 82 in 2018, which is its highest level since 2008. So that wraps up the P&C section. For the rest of the presentation, it's going to be all about workers' compensation, and we're going to start with premium. So I mentioned earlier that private carrier net written premium increased by 8.5% to $43.2 billion. That's the blue portion of the bar, and that's your in delivering. Net written premium rose sharply. That's similar to the growth rate that we saw coming out of the Great Recession, but the source is actually different. Back in 2011 and 2012, the growth arose from an increase in payroll. But this year, the BEAT provision eliminated the tax advantage of ceding to offshore affiliates. And that increased net written premium sharply. In fact, the change in ceded accounts for the vast majority of the increase in net written premium. The premium for state funds is in orange, and it increased at a much smaller rate than we saw private carriers increase. But in total, premiums have finally exceeded their pre-recession peak, which was back in 2005. Now, before we decompose the changes that you see here, let's pause for a second and look at residual market premium. So I say for a second because there isn't a whole lot going on with residual market premium, and that's a good thing. The size of the NCCI serviced pools has hovered at around $1 billion since 2013. A stable residual market is one indication of a healthy system, signaling that risks can find coverage in the voluntary market. And when we look at the residual market share, it's a similar story. It's been between 7% and 8% since all the way back in 2013. Managing the plans and pools allows NCCI to kind of keep its finger on the pulse of the industry via the unique viewpoint of the most difficult risks that can't find coverage elsewhere. One of NCCI's annual objectives is to ensure that the residual market is self-funded, and to achieve that, we focus on adequate assigned risk rates and the appropriateness of the reserves in the pools that we manage. And right now, all the metrics are pointing in a very good direction. Now we're switching back to the total market for private carriers to look at direct written premium. So in contrast to the significant increase we saw in net written premium, countrywide direct written premium decreased slightly by less than 1% in 2018. And that's your D in delivering. Direct written premium was flat. For the rest of this section, we're going to investigate the underlying cause of this small decrease. So let's start by looking at the change in direct written premium by state. You can see there's quite a bit of variation here. Now, a few states are blue, and that means they had an increase in direct written premium. In Kentucky, a self-insured fund converted and became a private carrier, and that contributed to the 20% increase in that state. Out west, two things drove Nevada higher. So at its simplest form, premium is the payroll times the rate. Well, Nevada took the top spot for payroll growth in 2018. And NCCI made a law-only filing to reflect an increase in permanent partial benefits, and that increased loss costs by 5.5%. Now, when we make each state's size proportional to the premium volume, it makes it easier for you to see which states are actually contributing to the overall decrease in direct written premium. Kentucky and Nevada are now pretty small, so their increase aren't contributing much to the countrywide number. Pennsylvania, though, got a lot bigger. There are a couple of reasons for the calendar year increase in Pennsylvania. One was a law-only filing that was in response to the Protz decision that increased loss costs by about 6% in 2018. Now, a few filings that were effective at the beginning of January in 2019 will serve to offset what occurred in Pennsylvania in 2018. California, Illinois, and Florida, they all drove the countrywide change. In those states, decreasing rates more than offset payroll growth. So you can see that changes in payroll, loss costs, mix of business, carrier discounting, and a whole host of other factors can impact direct written premium, and that can vary widely by state. Before we look at the overall change by component for 2018, we thought it'd be interesting to look at the cumulative 3-year period from 2014 to 2017. We've got that here. At the bottom, you can see that private carrier direct written premium increased by 2.5% over those 3 years, so not a lot of new premium. But when you look at the change in payroll up at the top and loss cost and mix, which is the second from the top, not only are they both significant, they're also offsetting, with increases in payroll more than offsetting decreases in loss costs. And when we look at the same information for 2018, the tide has now turned, and loss cost decreases in orange are now more than offsetting payroll growth. Carrier discounting is once again a small contributor, and then the overall change at the bottom is now a small decrease. Indications across almost all NCCI states have called for significant loss cost decreases. I'm going to show you the breakdown by state and investigate the underlying cause in a minute, but first let's drill down into each of the components that you're seeing right here on the slide. Let's start with payroll. The change in payroll can be driven by either a change in wage or a change in employment, and both increased in 2018, but wages in blue grew at a faster rate than employment, which is in orange. That's your first E in delivering. Employment, wages, and payroll all increased. Now the white vertical line, that's the average increase across all the sectors. And by sector, wages grew the most for professional and business services and construction. Over on the employment side, the same two sectors grew at an above average rate. Just like last year, construction was the fastest growing sector. But professional and business services is the largest sector, so it accounts for about 25% of the payroll growth that you see here. So this shows the impact of approved NCCI rate and loss cost changes, the filings that we've made on the Bureau premium level by effective year all the way back to 2003. Now, when you look across the period, you can see how different 2018 and 2019 are compared to the prior years, with a weighted average decrease of close to 10% each year. One of the most common questions that we get when we visit carriers and regulators is, why are loss costs decreasing? So we thought we'd add the following section to walk you through what we're seeing. Each year, after an extensive period of validation, our state teams analyze the data to determine the overall rate or loss cost change for a state. The indicated change is then presented to a panel of actuaries to review the methodologies and selections for reasonableness and consistency across all the jurisdictions. And this gives a few of us a bird's eye view into the commonalities that are present across the country. There are 4 main areas where these can be present, and they're all here on the slide: experience, development, trend, and benefit changes. Here's what we're seeing in each of these. The experience period that's utilized in a state's filing is typically the most recent 2 policy years, but some smaller states do include more. During the new filing cycle, the oldest year rolls out and then it's replaced by a new year. Since we've regularly seen improved experience over time, the new policy year coming in is better than the one that's falling off. And all else equal, the improvement in experience has contributed to the loss cost and rate level decreases that we filed. Now, development is another area where we've seen significant improvement. Claims are closing faster, and both the policy year and accident year development factors have been more favorable than we've seen historically. This gives you an idea of how development has changed over time. From 2013 to 2017, paid development dropped by about 4%. That's the orange line. And paid plus case development, which is paid losses plus case reserves, dropped even faster by more than 6%. One possible contributor that we're following is the decrease in opioid utilization in recent years. At the end of 2013, we found that 55% of claims that had at least one prescription had also at least one opioid. By the end of 17, though, that had dropped to 40%, so some good progress there. So favorable loss development on both a paid and a paid plus case basis has put downward pressure on the rates and loss costs that we filed. Trend factors recognize the impact that inflation has on losses over time. NCCI reviews both the frequency and the severity components when we're selecting a loss ratio trend for our filings. Now, we're going to dissect the impact in the loss driver section, but you can see here that over the last 20 years, frequency, which is on the left, has been decreasing at a faster rate than severity, which is on the right, has been increasing. And severity changes have been very moderate in recent years. You can see how that blue line has flattened. As a result, we've lowered trend factors in almost every jurisdiction. And that's another contributor to the lower loss costs that we filed. And then finally, we consider the impact of indemnity and medical benefit changes. With few exceptions, we haven't seen major changes in indemnity benefits in recent years. We highlighted that in our SSDI research, which came out about 2 years ago. But it's important to remember that benefit changes include more than just wage replacement benefits to the injured worker. For example, a change to a drug formulary or a medical fee schedule that impacts payments to pharmacies or hospitals or physicians, that's also included in this category. And a seemingly small change to medical benefits, like lowering the number of days that an opioid can be initially prescribed, can indirectly impact experience, development, and trend. So while filed benefit changes have not been a primary driver of the loss cost decreases that we've been filing, experience has improved, development has been more favorable, and our trend factors have decreased. When you put all of that together, as of today, every state, with the exception of Hawaii, decreased rates or loss costs in the most recent filing cycle. And that's your L in delivering. Loss costs have decreased. In fact, a third of NCCI states approved double-digit decreases in the most recent filing cycle, as did California, Delaware, New York, and Pennsylvania. So the final category impacting direct written premium is carrier discounting. And that includes schedule rating, rate or loss cost departures, and dividends. So carrier discounting has really been quite moderate over the last 7 years or so. In fact, you have to go all the way back to 2011 to see more than a 5% impact on the premium level. Back in the late 90s, which are kind of little by little rolling off the slide, the market was incredibly soft and carriers were discounting by more than 20%. But in recent years, carrier discounting has actually increased premiums slightly. If we look at the components, you can see that that increase is coming from upward rate and loss cost departures, those are the blue bars, offsetting the more moderate schedule rating credits in orange. Dividends, which are up at the top in white, they really aren't much of a player in the private carrier market anymore. They're only utilized in a couple of states. So in 2018, carriers awarded fewer schedule rating credits and slightly increased their upward rate and loss cost departures. But none of the changes were enough to significantly move the needle on direct written premium. Here's the latest CIAB pricing survey as of the fourth quarter of 2018, and the percentage of respondents seeing price increases at renewal continues to get smaller. Only 5% saw an increase at the end of 2018. And the majority of agents reported seeing price decreases on their workers' compensation book at renewal. So that wraps up premium. Before we break down this year's combined ratio, let's take a walk down memory lane and look at how the past few underwriting cycles have impacted the combined ratios over time.
The underwriting cycle describes the tendency for market conditions in the workers' compensation insurance industry to ebb and flow over time. Periods known as soft and hard markets are characterized by differing levels of premium, profitability, and coverage availability. Changes in market conditions are influenced by several factors, including investment rates of return, the financial capacity of the industry to write new business, and the occurrence of economic or catastrophic shocks to the industry. Let's dig into some of the underlying characteristics of each type of market. Soft markets are generally described as periods during which coverage is widely available, and the insurance companies lower prices to actively compete for business and grow market share. These phases may be associated with the combination of relaxed underwriting standards, available financial capacity to write new business, relatively few catastrophic shocks to the system, and a favorable economic environment. As a soft market builds, industry reserve deficiencies may accumulate as companies release reserves to offset increased underwriting losses. On the other hand, underwriting hard markets generally describe periods of relatively higher prices, tightening underwriting standards, reduced carrier financial capacity, and depressed investment returns. A hard market sometimes follows the occurrence of economic or other shocks to the system that result in low or negative returns on surplus. In the epic soft market of the mid to late 1990s, carriers lowered prices to levels below the cost of losses, expenses, and dividends. This resulted in several years of deteriorating combined ratios. Relatively strong investment returns over this time period helped to offset increasing underwriting losses. Then things rapidly changed. The dot-com bubble burst in 2000, followed the next year by the tragedies of 9/11, shocks to the system. Changes to the insurance marketplace were immediate. Excess capacity dried up, insurance companies tightened their underwriting standards, and increased prices. Coverage was harder to find, and investment returns deteriorated. This was the beginning of a hard market that existed through about 2006. During this period, industry reserve deficiencies were reduced, as new accident years were added with strong reserves. The heightened focus on underwriting, along with insurance price increases, contributed to this period's improved combined ratios. But history repeats itself, and the industry entered another soft market, bolstered by confidence related to improving year-over-year underwriting results. The market was appealing to new entrants, and carriers were willing to reduce prices to expand their market shares. However, the shock of the Great Recession caused this soft market to be short-lived. An extended period of notably low investment returns forced carriers to focus on underwriting to maintain profitable books of business, and beginning in 2010, the insurance industry found itself in a hard market, which continued for the next several years. In recent years, the market for workers' comp insurance has been atypical, with elements of both soft and hard markets present. Insurance prices have been generally decreasing at renewal, coverage is readily available, and competition is high. However, combined ratios have improved, and the level of reserve deficiency has remained low. So what has likely contributed to this? Well, advances in technology and data analytics have provided insurers immediate access to data and feedback on underwriting, pricing, and reserving decisions, enabling them to quickly respond to changes in the market. Some have suggested that technological advances may have also contributed to lower claim costs through automation, cost control, and fraud detection. In addition, the availability of non-traditional sources of capital has lowered the cost of reinsurance and allowed insurers to keep prices low. How long will this environment of moderate underwriting cycles last? Will the blend of traditional soft and hard market characteristics continue? Only time will tell.
Okay, so with that as a historical backdrop, let's dig into the results. Now, in last year's State of the Line, I said you had to go all the way back to the 1940s or 1950s to see a sub-90 workers' compensation combined ratio. And now we've had 2 consecutive years of historic results. 2018 was the lowest combined ratio on record, at least back to the 1930s. Now, I didn't dig into the microfilm and look at that, but so it could have been longer, but at least back to the 30s. And that's your V in delivering. This year, we had a very low combined ratio. If you take a look at the orange line, the drop from the combined ratio peak to the trough during the last underwriting cycle was 29 points. And then the next peak came in at 115, but it's been decreasing ever since by 32 points to a level significantly lower than the last trough. So we asked ourselves, are all carriers seeing better results? Well, the answer is no. And to come to that conclusion, we started by isolating calendar years 2014 through 2018. The blue line is the average combined ratios, and we plotted the distribution of carriers around that average. So each bubble is a carrier's combined ratio, and the size of the bubble is based on the premium volume for that carrier. And here's what we found. So first, the distribution of carrier results varies dramatically within a calendar year. For example, in 2018, the middle 50% of carriers had combined ratios that ranged from the high 70s to about 100. Then we focused on the 30 or so carriers that are concentrated right at the median in 2018, and we tracked those carriers back over time. In 2017, they're already very dispersed, and even more so in the older periods. Not only are carrier results varying widely within a year, individual carrier results can vary substantially from one year to the next. Now, if we break the combined ratio into its components, 100% of the decrease was coming from the loss ratio. The LAE, underwriting expense, and dividend ratios were all flat, while the loss ratio dropped by 6 points. The increase in net earned premium in the denominator contributed 4 points, and then the decrease in losses in the numerator brought it down another 2 points. So the data is different that you're looking at here, but this supports the numbers that are underlying our filings. Loss experience, development, and trends have all improved. Now, if we take premium out of the equation and look at LAE relative to loss, the increase is pretty dramatic. Now, this is partly because the dollars of LAE increased, but it's also because losses in the denominator decreased. LAE could be increasing because carriers are investing in technology and analytics to identify and monitor those claims that are likely to develop poorly. While this improves the ultimate outcome of the claim, it increases LAE. And another possible contributor is out in California, where ALAE has been increasing sharply in recent years. Okay, so to wrap up the combined ratio, let's look at the residual market combined ratio for NCCI serviced pools. So these are on a policy year basis, not calendar year. Year in and year out, the most recent policy year is typically higher due to its relative immaturity, and then it improves over time. Policy years 2015 and 2016 are a little more mature, and they're a pretty good indication of where they will ultimately land. They're currently less than 100, and that means that even the residual market is experiencing small underwriting gains. But in most years, it takes more than underwriting expertise to be successful in a long-tailed line like workers' compensation. Investment income is important. Now, these numbers are from the annual statement IEE, where investment gains are separated into those attributable to insurance transactions and those that are attributable to capital and surplus. Here, we're only focusing on the investment gains from insurance transactions. So our preliminary estimate of the 2018 IGIT is 9%. That's a little lower than recent results, and it's below the long-term average of 12.9%. And that's your first I in delivering. Investment gains slipped a bit. The pattern is similar to what you saw for the P&C industry as a whole, with the low point back in 2008. So investment gains have really been pretty good considering the interest rate environment. Now, one thing to note is the year-to-year volatility in the ratio. While the others sort of ebb and flow with the underwriting cycle, the investment gain on insurance transactions reacts primarily to outside economic forces. So a 9-point investment gain from insurance transactions and a 17-point underwriting gain led to a 26-point operating gain. That's almost 4 times the 20-year average operating gain. And now we have our G in delivering. Gain from operations increased significantly. The calendar year combined ratio that we just reviewed is the most commonly quoted, but the accident year provides a real measure of the current health of the workers' compensation line. Another important gauge is the estimated reserve deficiency, and I've got both of those in this section. So let's start by comparing the calendar year combined ratio, that's on the left and in blue, to the accident year combined ratios from the NAIC annual statement. These are as reported by the carriers, and they're on the right in orange. Note that from 2017 to 2018, the calendar year combined ratio improved by 6 points, while the accident year deteriorated by a point. So this is the second year in a row we've seen this phenomenon. Last year, I said that the accident year combined ratio for 2017 was going to come down and ultimately be close to the calendar year combined ratio. And we still think that's going to happen. But now look at 2018. When the most recent calendar year is better than the accident year, that means total reserves for prior years were decreased. NCCI also believes that that pattern is going to continue. On this slide, we've kept the accident year reported combined ratios on the right, and then we've replaced the calendar year with NCCI's estimate of ultimate accident year combined ratios. In other words, this is how we believe each accident year is going to develop over time. You can see that we think 2018 is going to develop quite favorably and similar to 2017. Both falling by about 8 or 9 points over time. Now that's a huge improvement. But while the estimated magnitude of the decrease is sizable, it's comparable to what we've already seen for 2014 and 2015. So the accident year is going to come down a bit, but for 2018, we don't think it's going to come all the way down to the calendar year combined ratio of 83. On this slide, we removed the underwriting and dividend expense, and that just leaves us with the reported loss and LAE by accident year and the selected numbers. The difference between the height of the bars, which is displayed in white, represents the redundancies for accident years 2012 and forward. For almost every year displayed, we believe that the current booked accident year results are going to improve over time. And the more recent years are going to improve significantly. When you put all of that together, our analysis indicates that reserves for private carriers are redundant by about $5 billion in total. Now, we've certainly seen individual accident years with significant redundancies in the past, but we couldn't find a period on record where industry reserves for private carriers were redundant in total. And now we have our R in delivering. Reserve deficiencies completely evaporated. NCCI considers all discounting, both tabular and non-tabular, to be deficient. The tabular discount is the allowed reduction in lifetime pension claims for statutory reserves, and that was about $4 billion in 2018. Without the tabular discount, we would have an even greater redundancy. It would be about $9 billion. So these lines show you how the last 10 accident years have changed over time. Now, while 2010 is the only accident year that's developed upward, it's in orange, it's developed upward since first report. All the accident years that you see here, including 2010, developed favorably over the last year, with accident year 2017 improving by 4 points, and 14 and 15 improving by 6 points since first report. Now, for those of you that want all the numbers underlying this analysis, they'll all be available in the State of the Line guide right after the presentation. So each year, NCCI researches several emerging loss drivers. And we're going to touch on some of the findings in this section in an attempt to shed some light on what we're seeing and what's changed in recent years. Here are just a handful of NCCI's recent research efforts covering a whole host of topics, from physician fee schedules to mega claims, and from motor vehicle accidents to employee demographics. One important update that's currently in the works is to review the mapping of class codes to hazard groups. This next video explains why this project is important and which areas could be impacted.
NCCI continues to explore ways to enhance our methodologies. One ongoing effort is related to hazard groups. As you may know, a hazard group is a collection of work comp classes that have a similar degree of risk for large losses. To fully appreciate the many uses of hazard groups, let's take a look at a few examples. In rate making, losses are limited, which helps to provide stability from year to year. The loss amounts that exceed that limit are spread across classes in the same hazard group. The formula for experience rating modification factors compares actual losses with expected losses. The purpose is to determine how the loss experience for an individual risk compares to the average experience for the job classification. The expected losses include an adjustment that varies by hazard group. Loss elimination ratios rely on hazard groups as well. These ratios take into account the indicated reduction in policy premium that results when an insured chooses a deductible. Hazard groups are also used in retrospective rating, where the final premium relies on excess loss factors by hazard group. As you can see, hazard groups impact every corner of workers' compensation in one way or another. To ensure these mappings are appropriate, we've begun a comprehensive review of the existing hazard group mappings. In possession of the industry's broadest and deepest workers' compensation database, NCCI's research team will analyze large volumes of industry experience and employ data analysis techniques. Our first task is to estimate class-specific excess losses. Losses from claims that exceed a variety of thresholds ranging from $10,000 to $10 million. Some classes may not have a reliable history of claims exceeding higher thresholds. This can happen in classes with fewer exposed workers, or less hazardous classes that have not experienced large claims for several years. When data is scarce or there are gaps to fill, statistical modeling and credibility approaches are used to weight these low-volume classes with supplemental information, such as larger subsets of classes. This helps ensure all classes are mapped to the appropriate hazard group. Next, we'll use the estimates of excess losses to group similar classes together. This cluster analysis is a data-driven approach used in machine learning and other fields to identify groups of objects that are similar to one another. Finally, NCCI will thoroughly review the results of the cluster analysis to determine if changes from the current hazard group mapping are needed. For example, a change in the mapping of classes to groups, or in the number of groups. Our team of classification experts will also review the new mapping for consistency, with their knowledge and experience related to the types of hazards and injuries typical of workers in the various job classes. This analysis is scheduled to wrap up by year-end, with plans to file any indicated changes next year. Stay tuned for this and more under Insights on NCCI.com.
Here's the preliminary timeline. A two-prong review of the assignment of class codes to hazard groups is currently underway. Internally, our actuarial research team will review the assignment of class codes with a large volume of data. And then externally, we've enlisted the help of our underwriting committee to review the class codes with either a low volume of data or those with unique exposure. So this is going to ensure that the mapping makes sense not just statistically, but also intuitively. So after the review phase, we'll analyze the impacts on ELFs and on our rate making, and if all goes as planned, we'll make a countrywide item filing sometime during the first half of 2020. Hazard groups are all about severity, so this is the perfect segue. NCCI's preliminary estimate for the change in indemnity severity in 2018 was an increase of 3% to $24,600. That's in line with the more recent years, a fairly moderate increase and close to the change in the average weekly wage that you saw way back at the beginning of the presentation, which was 3.3%. This graph gives you an idea of how indemnity severity has changed over time, but to put the long-term history into context, you really need to compare it to wage inflation. So here we've calculated the cumulative change in both indemnity severity and wage inflation, and we've indexed them both back to 1998. Since then, indemnity claim severity for NCCI states has doubled. That's the blue line. But the vast majority of that was a direct result of wage inflation. That's the orange line, which increased about 80% over the period. Now, another way to look at it is that wage inflation explains about 80% of the increase in indemnity claim severity over the last 20 years, which which is kind of what you'd expect, right? Because indemnity benefits are typically tied to the average weekly wage. Now, if we take the slide, though, and divide it into two equal sections, from 98 to 2008 and from 08 to 2018, the result is a little more interesting than we've seen in the past. So on the left, before the Great Recession, the growth in indemnity severity far outpaced wage inflation. But over on the right, compared to the older time period, wage inflation increased at a much slower rate. And indemnity claim severity has basically flatlined. Over the last 10 years, wage inflation has outpaced the growth in indemnity severity, and the orange line that used to be on the bottom is now on the top. So in a minute, you're going to see the story for medical severity is comparable, and a contributor to the moderate indemnity and medical severity changes could be medically related. Here we have the average change in indemnity severity by state, and this goes from 2013 to 2017. And the word, again, I would say is moderation. Most states are a shade of light blue, and that means that they've had a little bit of an increase, and there are only a few states that are light orange. The darkest blue state is Hawaii. A few large losses at the end of the period was the driver there. And then we've talked about Oklahoma and Tennessee in the past. Reforms are likely contributing to the decrease in indemnity severity in those states. All right, so now let's move on to medical. Medical lost time severity increased slightly by about 1% to 28,900 in 2018. Both indemnity and medical severity changes were moderate, and that's your second I in delivering, and we only have one letter left. Just like indemnity severity increases with wage inflation, medical severity includes the impact of medical inflation. So for medical, the orange line that you see here is the Personal Healthcare Chain Weighted Price Index from the Center for Medicare and Medicaid Services, and that's NCCI's proxy for the workers' compensation medical inflation. The blue line is the cumulative change in medical lost time claim severity, and again, they're both indexed back to 1998. Medical severity has grown 2.5 times faster than the medical price index over the last 20 years. But you can see here that all of that arose between 1998 and 2008. When medical severity grew notably faster than the price of medical care. Over on the right, the lines are tracking one another, and they're both sort of increasing at a snail's pace. Why is this happening? Well, there's several theories. I mentioned earlier the reduction in opioid utilization could be impacting not just medical, but also indemnity by shortening the duration of claims. We've also talked about technology. Carriers are identifying and triaging and managing claims that are likely to develop poorly. But it's also possible that the industry's intense focus on medical cost containment just took a while to kick in, and it's finally paying off. So whether it's one or all of the above, what's clear is that the graph on the right has a different slope than the one on the left, and that is what's driving our filed trends lower. Here's the average annual change in medical severity by state. Most states are a shade of light blue, and that means a moderate increase. Virginia and Nevada are darker. They were impacted by large losses at the end of the period. And Colorado had large losses at the beginning of the period, and that's caused the Centennial State to be a shade of light orange. Now, if you're interested in large losses, you want to make sure to come to Barry Lipton's presentation at the end of the day today, because he's going to have an update on our mega claims research and show you the latest data there. Let's wrap things up with frequency. So I thought we'd start by contrasting the average annual change in frequency with the map that you just saw for medical. It's like a sea of orange, and it really emphasizes the degree to which claim frequency has been decreasing in recent years. But this only goes through 2017. So what about 2018? Well, our preliminary estimate shows that lost time frequency decreased by 1% in accident year 2018. The potential for a more moderate decrease or even an increase received a lot of attention in 2018. In fact, NCCI reached out to over 20 carriers in the fall to get an early read on where this number might land, and negative 1% is in line with our expectations. Now, we've identified 3 potential underlying causes for the moderate decrease. Your last E in delivering is that economic factors could have contributed to the milder decrease in frequency. Previous research has shown that a strong economy with new job growth can put upward pressure on frequency. As the labor market tightens and employers are forced to hire untrained or inexperienced or less qualified workers, the likelihood for an injury does increase. And currently, the ratio of available workers to job openings is less than 1 and the lowest in recent history. So that's one plausible explanation. The second that we heard from carriers was all weather related, in that several carriers mentioned that they saw an increase in slips and falls during 2018's severe winter. And then finally, it could just be random volatility similar to the decrease in medical severity that we saw back in 2015. But it's important to remember that lost time frequency can vary significantly from one carrier to another. So this is similar to what we showed you for the combined ratios. These last 2 slides are going to look at frequency level by carrier group over the last 9 years. Now here, the size of the bubble represents the actual volume of earned premium for each carrier. The blue line is the average frequency for that accident year, and of course it's been decreasing over time. Now we've highlighted the carriers with very high frequency, those are in blue, and those with very low frequency in orange, and then we tracked those carriers back over time. What we found is that individual carrier frequencies can be volatile from one year to the next. But carriers with relatively high frequency in the most recent year had relatively high frequency for most of the prior years. And then the same was true with carriers with low frequency. A tendency for carriers to focus on either high or low frequency sectors could be causing the result that you see here. And here's what you saw at the outset. So pretty much all of the key takeaways are right here on this slide. The industry is not only delivered on its promise to the injured worker, but it's also delivering very strong financial results. So that wraps up this year's State of the Line. Don't forget, all the major takeaways, calculations, numbers are right now available in the State of the Line guide. Thank you for your attention and enjoy the rest of the symposium.